Matthew, are you still in the search process, or did you acquire a company already? Gotcha, small PE fund. Search funds, opportunity zones, in my opinion, are quite a nice match. I'll tell you first who I am in 30 seconds. So this is me back in undergrad. I was doing data analysis at a particle accelerator at Oak Ridge National Lab. I was a physics major, ended up switching to math. Worked at a couple national labs, was in a PhD program for math for a while, ended up dropping out of there after 3 years, joined a legal tech startup, also spent some time at Los Alamos, which sadly I don't have any pictures of the inside of because we were not allowed to take any pictures. It was kind of fun. Did some security clearance requiring cybersecurity stuff. This is me in Seattle. Worked at a contract management startup, got into the legal space. And after that, I came to South Florida a couple of years ago where I was working, I started a prop trading company. So was there for a couple of years and came across the problem of how do I escape massive capital gains. That led me down a rabbit hole of looking for every strategy possible to get rid of capital gains. And opportunity zones were the most interesting one. I wrote a blog article about capital gains, about opportunity zone capital gains tax loopholes, and ended up going viral on Hacker News. And so after that, I ended up getting a pretty large stream of people coming to me asking for help setting up their own businesses to be opportunity zone businesses. Essentially what the article was about was how you could use opportunity zones for business rather than just real estate. Right now, opportunity zones are about $100 to $200 billion market each year. So each year there's about $100 to $200 billion of new money that goes into opportunity zones. And the vast majority of that goes into real estate. Now I basically help high net worth individuals and family offices to invest in opportunity zones. There are a few different families that I work with, some entrepreneurs who have exited companies. So I would say probably the typical client who comes to me is somebody who had a company, tech company, sold it, has a bunch of capital gain. They're trying to avoid this massive tax bill. They like the idea of investing in another business instead of just in real estate. And so they end up coming to me and I see if I can help them. Now, why are opportunity zones awesome? First, they are one of the only tax loopholes that gives businesses as much tax privilege as real estate. So real estate comes with a lot of different benefits. Depreciation is one of them. Another of them is the ability to do something called a 1031 exchange. A 1031 exchange is essentially if I have real estate, I sell it, I reinvest within 6 months, and I get to defer the capital gain on that sale. There is nothing equivalent for stocks or business, but there's opportunity zones, which sort of is equivalent actually. In addition to that, opportunity zones have other benefits, but we'll get into that. Second benefit, it's the only tax loophole that lets you sell a business for $1 billion and pay zero capital gains tax, which is something that some people are looking for. If you have these huge gains, there's another tax loophole called the qualified small business stock rule. And it applies to tech companies, for example. If you sell your tech company, up to $10 million of the capital gain can be excluded from taxation, but that comes with its own limitations. One of which is it only goes up to $10 million. Another of which is it doesn't apply to a lot of service businesses. It applies to like manufacturing businesses, sort of high-tech manufacturing businesses, some e-commerce businesses, tech businesses, but it does not apply to a host of other businesses that are common in the search world. Opportunity zones also let hedge fund LPs, if you're not familiar, an LP in parlance of hedge funds is a limited partner. So if you have someone who works at a hedge fund and they have some carry in that fund, so they're getting a decent amount of capital gains, and that can be a mix of short and long-term capital gains. Either one can be rolled into an opportunity zone, which is pretty nice. And it's basically the only tax loophole that lets you do that. And a lot of high net worth individuals and family offices have investments in hedge funds. So even if they're not selling a business, they're still likely going to have capital gains that are coming in from their high liquidity investments into hedge funds. And so they're constantly on the lookout for, where can I deploy this so I can eliminate the capital gains? One of the classic ways to try to do that is with real estate, which can work for short-term capital gains. But again, it's only real estate, it can work with long-term capital gains, but it only works with real estate and it doesn't work with short-term capital gains. Opportunity zones are kind of strange in that a lot of tax loopholes that come into play for real estate require you to have passive income or gains that are just from real estate, but opportunity zones are extremely general. It can be literally capital gains, short or long-term, from any source. It's also the only tax loophole that lets you permanently eliminate all your capital gains without dying or giving away your wealth. So, if you die, you can pass on your wealth to your kids, and there's a step up in basis. You can obviously donate your wealth, but if you want to keep your wealth and not die, then you need an alternative, and opportunity zones are that alternative. And finally, they're also Biden-proof. So the past several years, we've had proposals which were put forward by a couple different senators and have been picked up and sort of championed by Biden for this billionaire tax proposal, which is kind of a misnomer because it's actually a centimillionaire tax proposal. And that is a tax proposal that would tax unrealized capital gains over a certain amount, over a certain threshold. And because of some details of how opportunity zones are structured and how the proposed taxes have been structured, so this is not a tax that exists yet, but it's a risk. So if you are talking to a family office that has a lot of investments, they're going to be thinking about these risks. And so that's one risk going forward, is that, this billionaire tax might be imposed. And if I put money into an opportunity zone, it's basically sheltered until 2047. I can hold it until then. So 24 years from now. And so that's pretty nice. All the money that you have in this opportunity zone, because of the way the opportunity zone tax rules are written, you actually, even if this unrealized capital gains tax comes into effect, it would not affect the opportunity zone investments, or at least it wouldn't affect them as much as it would an ordinary investment. And that's even true of some comparable things in real estate, like 1031 exchanges would still be affected by the billionaire tax, whereas the opportunity zones wouldn't. And there's also been tax proposals the past couple of years to change the capital gains tax rates. So that's another thing. If you're talking to an LP or a potential LP, that's something they're looking at in their tax planning. And it's an opportunity zone investment is one of the few things that can give them, hey, this can protect you from that through 2047. So the problem I'm trying to solve, right? I work with high net worth investors right now. Is that there's not enough opportunity zone businesses to invest in. Basically, like I said, it's $100 to $200 billion a year that's going into this, but it's mostly going into real estate. Far more, if you look at the ratio of how much private wealth goes into private equity versus private equity of genuine businesses versus private equity real estate, and then you look at the ratio in the opportunity zone space, the opportunity zone space is way skewed towards real estate. Essentially, all of that 100 to 200 billion is going into real estate. But again, the fact that the ratio within an opportunity zone market is different than the ratio outside the opportunity zone market is indicative to me of the fact that there's an opportunity here. And I see this when an investor comes to me and they're like, "Hey, I like the idea of investing in an opportunity zone business, but I don't have where's the business?" So right now, what I typically do is I will help them set up a business. And so they might already have an idea for a business, like, hey, I want to start this kind of business. I get bored easily. So help me set up a new business and we'll structure it as an opportunity zone business. Other times, we're like, they'll say, okay, I don't want to operate it myself. I don't want to actually start another business. I just want to invest in a business. And sometimes I can help them to structure that business and find, the right people. Usually they already have the right people, right, somewhere in their network. And then it's a matter of setting up the business, hiring the right people. But that's kind of a slog. Like there's not a lot of businesses out there. Like I don't have a repository of opportunity zone businesses that I can just pull from and say, hey, here's a great opportunity, invest in this one. So also, I think search funds are particularly well positioned to take advantage of this because it's really the ideal type of business. Like VC fueled startups are kind of tricky to fit into the opportunity zone bucket for several reasons. One is that successful VC startups typically are not Facebook and Google. Most successful VC startups end up being acquired. And if they are not acquired, they end up acquiring a lot of other businesses. So either way, if they're acquired in less than 10 years, there's no tax benefit for the investor because an opportunity zone investment has to be held for a minimum of 10 years. And if they end up acquiring a lot of businesses, then there's a rule that we'll talk about later, which is called the non-qualified financial property rule. And basically an opportunity zone business can't hold more than 5% of its assets as non-qualified financial property, which includes stock. So if I acquire the stock of another company, that doesn't work. If I acquire a partnership interest in another company, that doesn't work. There's really two ways that you can acquire things. You can acquire other businesses from inside an opportunity zone business. The first is an asset sale. So you can always do asset purchases. The second is you need to structure the business. If it's a C Corp, you need to transition it into an LLC. If it's already an LLC, great. And then you need to wholly acquire it. So if you own 100% of an LLC, if your QOZB, your qualified opportunity zone business, owns 100% of an LLC, it does not count as non-qualified financial property. So you're safe in that regard. But it's hard to do that for a VC fueled startup because usually you have stock for stock deals, and there's just too much M&A activity going on. Additionally, you end up hiring people from all over, and when you're hiring like hundreds of or thousands of people a year, it's just really tough to stay within the guide rails of the opportunity zone framework. So because of that, it's really hard to invest into those types of businesses. You can invest into small businesses. So you could acquire a restaurant that's in an opportunity zone. That works perfectly fine, but that's not a great business. Restaurants don't really do that well. Don't have great economics. Most restaurants fail. It's not overall something that most investors are trying to invest into. Random restaurants. The search fund size and style is like the ideal sweet spot because you're generally looking for a type of business that is somewhat scalable, right? It's a genuine business. It's not too tied to real estate usually, which means it's easily relocatable. And you have this growth potential. If you're buying a business anywhere from $1 million to $50 million, that size of business in an area that a searcher is going to be acquiring, right? So you're not acquiring, a SaaS business at 20 times multiple that's growing super fast. You're buying a business that's hopefully growing, but it's not growing ridiculously fast. You're not buying a business that's tripling in a year for 5 years in a row. So you're less likely to run into these M&A issues or the growth, hiring, payroll issues that a VC company would run into. So if you can find a business that's in your search space, again, anywhere from $1 million to 50 million, like that range, that size range, and let's say that you expect to grow it at like even up to like 20% a year, 25% a year. That's a solid growth rate, well above average. But at that growth rate, you're not going to really run into the types of problems that the VC companies will. So you're well within like the sweet spot for opportunity zone businesses. So how do opportunity zones work? Here's the basic step-by-step process. Number one, an investor sells a business, or they sell stock, or they sell real estate. Somehow they generate a capital gain. So let's say that capital gain is $1 million. Second, the investor needs to take that capital gain and they have to invest it into an LLC typically it's an LLC. It can be something else, but typically it's an LLC that files the necessary paperwork to be a qualified opportunity fund, or QOF. And they need to do that within 6 months of when the capital gain was recognized. So most of the people who come to me end up coming to me, I would say 1 to 2 months before this 6-month window expires. So they have the capital gain. They don't think about it for a little while. They're happy that they sold their business. And then they start thinking about the tax, or they, have their quarterly meeting with their tax advisor. And then the tax advisor tells them that they're going to owe, potentially millions or tens of millions or hundreds of millions of dollars in taxes. And then they start thinking, oh shit, I need to, is there a way to escape this? They start furiously researching. And then they realize, oh, there's this thing called opportunity zones. Let's see if I can fit into that bucket. And then they usually, often only have like a month or two left, and then they need to invest into that. After that, they set up this business, they invest into it. Then they have another 6 months for that QOF to invest into a qualified opportunity zone business, or QOZB. So a QOZB can mean real estate. It can mean, hey, I just bought an apartment complex and I put it into an LLC, and that's my opportunity zone business. Or it can be a SaaS company, or it could be a home services company, or it could be an IT services company. It really can be anything. That qualified opportunity zone business is quite flexible. You have to meet some conditions that we're going to talk about, but it can be almost any type of business. After that investment happens, the investor gets to defer their taxes on the original capital gain. So remember, they had $1 million of capital gain, we're assuming. They get to defer taxes on that until 2027. So if they had $1 million of capital gain, they would normally owe $200,000 of capital gain taxes, but that would be deferred until 2027. So that's the deferral aspect. That's what most people know about opportunity zones. If they find an opportunity zone, again, like the people who come to me, it's typically because of the deferral aspect. They're like, oh, I can defer, my capital gain for several years. That's great. It's basically getting an interest-free loan from the government for 4 years. That's pretty nice, especially if you're getting an interest-free loan on $100 million. That's pretty fantastic. But it's the smaller of two benefits. So the much larger benefit, which they only realize after they start getting into opportunity zones, is that if the investor holds their opportunity zone investment for at least 10 years, then they get to pay zero capital gains tax on it when they sell it. So that's worth way more. And they have to hold it for at least 10 years, but they can hold it up until 2047 at the latest. So if the investor bought the $1 million business in 2023 and it grows over 20 years and they sell it in 2043 for $6 million, they would have $5 million of capital gain on that, which means $1 million of capital gain tax, assuming the capital gain tax rate doesn't go up before then. But because they invested through an opportunity zone, they don't have to pay that $1 million tax. It's just eliminated. That's not a deferral. It's a pure elimination. It's permanent. They never have to pay that $1 million of capital gain tax. So originally they deferred $200,000 of capital gain taxes, but then later they got to just eliminate $1 million of capital gain taxes. So it's really the second benefit that's way massively larger than the first one. So you have these two benefits. The tax deferral happens first. You get to defer on that first capital gain. And you have to keep this in mind too as we talk about capital gains. There's two capital gain events, right? The first one is the investor has a capital gain. They defer it by investing in the opportunity zone. But then later they sell their opportunity zone business and they get a second tax benefit. So that's the two parts of the opportunity zone framework. Comparing it to the main alternative tax loophole, which is the qualified small business stock. So the middle column there is QOZB, that's the qualified opportunity zone business. The right is the QSB, which is qualified small business. So if you have qualified small business stock and you sell it, you can exclude up to $10 million from capital gains. If you have an opportunity zone business and you sell it, you can exclude unlimited amount of capital gains. So that's a huge difference. Plus, you have way more eligibility. So the QOZB business is very flexible. Basically, it's very difficult to fit finance and investment businesses into the QOZB framework. So if you want to acquire a mortgage lender, probably Opportunity Zone business is not going to help you. Yeah, 10 million per investor. So if you have a spouse, that can increase it. But if you have a family office that has already used up, like you're talking about a centimillionaire family or a billionaire family, they have already used up their 10 million per person. If you have an entrepreneur who sold their business for a couple $100 million, they have far more than they can write off with the qualified small business stock rule. So the qualified opportunity zone business rule is really this like whale that they can go after. And, typically what you'll see is this investor or this entrepreneur, they're going to sell their business. They're going to use up their qualified small business stock. They're going to say, I'm married. I get 10 million. I give some to my wife. I maybe can structure it so that I put some into trust for my kids. But I end up using up that amount, and then I still have money left over. And so then I'm going to put some into the qualified opportunity zone businesses. Most of that's probably going to real estate. If I can find a business that's also an opportunity zone business, I might invest into that also. And you have these, from the perspective of the opportunity zone entrepreneur. So if you're a searcher looking at, okay, from your perspective, what's the difference? There's also this industry difference. So an opportunity zone business, you're good, right? Basically, finance and investment, can't do that. There's also a list of sin businesses. So these are things like, that's kind of funny. They're called sin businesses, but it's basically like golf courses, massage parlors, liquor stores, things like that. If it has an excise tax on it, like a social excise tax, it's probably a sin business. So you can't invest in those. But other than that, it's basically just finance and investment that is hard to do for opportunity zones. For qualified small businesses, most search funds are not going to qualify for that because you're excluding engineering companies, architecture companies, health companies, accounting companies, actuarial companies, consulting companies, finance companies, brokerages, law firms, content businesses, leasing businesses, banking, farms, hotels, restaurants, skilled trade businesses, anything that relies on the particular skills of one or more employees. All of those are excluded from the qualified small business tax rule. So it's really honing in on like, are you creating sort of manufacturing businesses, software businesses? But those are not always what searchers are going after. And so all of these like nice sort of B2B service niches, most of them just don't qualify for the small business, qualified small business tax rule. So compliance. There are a number of different rules that you have to meet and maintain to have a qualified opportunity zone business. So you find your search target. What do? Number one, you need to form your QOZB as a special purpose entity or an entity. You can get away without doing this part, but it's highly recommended that you do not. It's you're much more likely to be audited if you don't do this. Or rather, when you're audited, you're much more likely to fail the audit if you don't do this. So you should form your business entity, your QOZB entity, with explicit writing in your organizational documents, your articles of incorporation or your articles of organization, to say, this is organized for the purpose of being a opportunity zone business operating in opportunity zones, something like that. It cannot be a sin business. So like I said, that can't be massage parlors, golf courses, liquor stores, sun tanning, tan facilities. There's a list of those that you can't do. If you satisfy those two things, then you have to meet the 50% rule. So the 50% rule says at least 50% of the total gross income derived from an OZ business must be derived from activity inside an opportunity zone. So that's a little bit confusing, or it can be, because what does it mean for income to be derived inside of an opportunity zone? And essentially, there are several different several different ways that you can meet this criteria. So the first way that you can meet it is at least 50% of the hours worked by the partners, contractors, and employees. You have to look at all of those groups, has to take place inside of an opportunity zone. So you say, okay, we bought this business, tally up all the hours of everyone who works at the business, including all your contractors. And if at least half of that is inside an opportunity zone, so your contractors are inside opportunity zones half the time, or half of your contractors have offices in opportunity zone, and also your employees, then that satisfies the rule. Alternatively, if at least 50% of the tangible property and management operations within an opportunity zone that are necessary for the generation of at least 50% of the gross income of the business. So this is kind of a nebulous requirement. Again, it's the tangible property and management operations within an opportunity zone. So you have some combination of tangible property and management operations, and those are necessary for the generation of at least 50% of the gross income of the business. So, for example, if you have a few key employees who do basically all the management work, and the rest of your employees are sort of customer service people, support people, they can be outside of an opportunity zone, and that's fine. As long as those few management people are inside, you're going to satisfy that rule. So then you're good. You also have another option, which is the facts and circumstances test, which is not very, that's just basically means we're going to look at all of the different, it's legal jargon, basically means we're going to look at all the different things that are going on in your business and make a judgment call. That's not super helpful. And then there's also payroll, which is probably the easiest to measure and stay compliant with. So you can track hours, but hours can be somewhat difficult to do if you have a lot of contractors, because you need them to log all of their hours and send them to you regularly. And if those records are not well enough structured, then they may not be able to hold up to scrutiny under an audit. And so that could fail. If you don't really deal with contractors and you mostly have employees, that could be easier and more manageable to do. But the payroll is easier. So the payroll is basically, looking at how much money are you spending on each employee and each contractor, and at least 50% of that needs to be payroll going to services and opportunity zones. So if you have an employee who works full-time in an office in an opportunity zone, that counts towards the 50%. If you have a contractor who, let's say an accounting firm that's in an opportunity zone and you're paying them, then that counts. If you have a contractor who works partly in an opportunity zone and partly outside an opportunity zone, then you have to look at, are they performing the services for you inside? Then you're good, you can count it. If they're not, you can't count it. So for example, let's say that you have a contractor come to repair, HVAC equipment that's at your office. If your office is an opportunity zone, then those services are opportunity zone services. So they count towards that 50%. And that's easier to track than the hours, right? Because if you looked at the hours, you may have to look at what is this, HVAC contractor doing in the rest of their business. So the payroll can be an easier test. And you just have to be sure that you're tracking all of this religiously. So you need to, in your books, make sure that you're tagging income, you're tagging expenses based on the location. And every time you onboard a new employee or a new contractor, you need to know, is this an employer or contractor who is performing opportunity zone services or non-opportunity zone services? Or is it a mix? And if it's a mix, you have to make sure that you record those two types of services differently. Next is the 40% rule. So the 40% rule says at least 40% of the intangible property of the business must be used inside opportunity zones. This is even stranger than the income requirement, because what does it mean for intangible property to be used in a particular location? And there's a bunch of rules that the IRS has written about this. It's kind of complicated, but you can think of it as like, if I am a business, right? Let's say I have a home service business. I'm in a pest control business, right? And I end up franchising it. If most of my if I have a franchisee who's outside of an opportunity zone, then whatever that does not count towards the 40%. If I have a franchisee who is in an opportunity zone, that does count. That's one example. If I have a licensing business, so something like Gym Launch, not a franchise, but I'm still licensing. Again, look at where your licensees are. Are your licensees in opportunity zones, or are they not in opportunity zones? Apart from the sort of franchising and licensing, you could also have something which is more conventional intellectual property, like copyright. If I have a copyright, then, am I selling that in mass online? If so, there's some nuance here. If I'm selling the books themselves, then that counts. If I'm selling just the intellectual property because I'm licensing it to a publisher, and the publisher is not an opportunity zone, then that wouldn't count. Also, you could look at things like, if I have intangible property in the form of software, like I have some custom software that I've capitalized. So if you are building software, you can do two types of things depending on how the software is used. You can either capitalize it or you can expense it. If it's expensed, it doesn't matter. If it's capitalized, then it needs to be basically running on a server that's in an opportunity zone to count towards that use in an opportunity zone. Or alternatively, it might be able to be located outside if it's only accessed from inside. So if you have a server that's outside an opportunity zone, but you never access it from outside, you always access it from computers that are inside the opportunity zone, then that would also count towards the 40%. If you have a trademark and you're advertising your trademark, let's say you sponsor a conference and that conference is not an opportunity zone, that would not count. But if you put your trademark up on a billboard or on a sign that's in an opportunity zone, it would count. So there's a lot of different types of intangible property. Patents, right, again, is going to vary. If I have a patent that I developed in-house and then licensed to let's say I have a biotech patent, right, that I develop in-house in an opportunity zone, I license it out, then that probably will count. But if I buy the patent and then license it out, and the licensee is not in an opportunity zone, it probably won't count. So you need to look at all the different types of intangible property that your business has, and figure out where those are located. If you do end up acquiring other businesses, then you might also end up with goodwill as an intangible property on your balance sheet. And that location is going to be dependent on basically where the other business is located. If you relocate some of the assets, then you're kind of going to carry a proportion of that goodwill to wherever the assets and people are located. So if you acquire a business, let's say you acquire, a small competitor that's not located in an opportunity zone, then currently, 100% of its intangible property is basically being used outside the opportunity zone. But if you, within a certain period of time, move those people or a majority of them and the intangible assets with it inside an opportunity zone, then the intangible property will come along with it. So that's a kind of nice feature, which makes acquisitions a little bit easier if you're going to pursue a roll-up strategy. Then you have the 70% rule. The 70% rule is the easiest of these. It's at least 70% of the tangible property that's owned or leased by the business needs to be qualified opportunity zone business property. So conventionally, if you're doing real estate in an opportunity zone, then that means that you need to either develop a new property, like you develop a new building, or you substantially renovate an existing building, meaning that you basically double the basis. So as much as the building is initially worth, need to put in that much more money to make it even more valuable. So you buy, let's say, a building for $1.2 million, 0.2 is land, and the other million is the building. Then you need to add another million in renovations to substantially improve it. But the nice thing about operating businesses is that you have a much more lenient rule. You can actually just lease property with that even if it's not substantially improved, you can lease property inside an opportunity zone business. And as long as it's new to you, it's new to your business, you're good. That counts as opportunity zone business property. If you buy a business, let's say that you buy a landscaping business, and the landscaping business is already located in an opportunity zone, then the opportunity zone, let's see, hold on, question here. For the leased property calculation, is it the approximate fair market value of the leased property, like a piece of equipment? It is. There's actually two different ways that you can do this. I think basically you're looking at the fair market value over something like a 10-year period. So you say, what is the fair market value of a lease or a right of use asset over a 10-year period? And then you chunk that up by year. And that's basically the amount of the asset that you're using. Is there a difference between operating and capital leases on balance sheet versus not? So in short, not really. It could depend on the structure of the lease. So if the lease itself is written substantially differently, then let's say that you look at something like a WeWork contract. WeWork is more borderline between lease and service. And that's a whole sort of set of questions in itself. Is like, there's a line between when is something a lease and when is something a service contract. So I would say, for WeWork, probably still falls on the side of lease. But there are some co-working spaces or types of co-working spaces. Like let's say you have an opportunity, you have a WeWork contract, which is you don't have a dedicated office, but you just have the right to use certain amount of, you can go in there for a certain number of days, or you can use the common space. That type of lease may well be a service contract rather than an actual lease, and as far as the IRS is concerned. So then if it's not a lease, it doesn't count as property. So it's not going to count for either way for your tangible property requirement. But it will count for the 50% requirement if you are looking at payroll or amount of payment that goes to contractors who are seen as performing some service. So if you have sort of a very flexible service-like lease, then they may end up just on the 50% rule. But for most leases, it's going to be classified as tangible property, and you're going to be looking at basically the fair market value of like a 70, of a 10-year period holding this lease. If your lease is shorter than 10 years, there are some adjustments you can make. But yeah, if you look at the regulations for leases, there's a couple different ways you can treat it. And so you can pick whichever one is sort of most optimal for you. No problem. All right, so back to the 70% rule. So yeah, so leases count. Again, on the line between leased and rent is, I would say, cloud contracts. So if your company has IT services, either that you're using internally or you are an IT service company, then you're going to likely have some sort of contract with a cloud service provider. So that could be as simple as Google Drive. You have G Suite or Google Workspace. If you have something like that, or it might be Box or Dropbox, it might be AWS, it might be storage buckets on AWS, it might be Bluehost. Each of these different cloud or IT service providers is going to have a different contract, and whether or not that contract counts as, are you renting a computer? Are you leasing tangible property? Or are you getting a service? So something that's like Google Workspace is a service. If it's something that's heavily managed, you never you never touch the underlying hardware. You have no idea what kind of computer it's running on. You don't know, you don't think about CPU, you don't think about performance per se. You're just like, I log on and it works. That's a service. On the other hand, if you're basically renting bare metal, like you find a cloud provider and the contract says, hey, we're going to basically give you remote access to this computer. If it goes down, we're sorry, we'll give you a small refund, but like ultimately it's up to you. Then that's probably a rental. And so that would count towards it could probably count against you on the 70%. So you want to be careful if you have a lot of expenses that are IT expenses or cloud service expenses, then you're going to want to be sure that most of those are not going to be inside opportunity zones. So they're probably either going to count against you on the 50% of gross income or on the 70% of the tangible property. And so you have to figure out, which of those buckets do you want it to fall into? Then we have the 5% rule. The 5% rule says no more than 5% of a QOZB's assets can be non-qualified financial property. So non-qualified financial property includes stock. You can't own like stock. It includes loans or debt, right? So this is why it's difficult to be a finance company. If I'm a lender and I'm holding a book of loans, those loans are assets to me. And if they have durations that are over 18 months, they're non-qualified financial property. So technically, you could have a finance company that was in an opportunity zone if it tended to do really short-term debt and get rid of it really fast, which is not usually that type of business doesn't really exist. Like typically, if you're an originator and you're selling your loan book, you're probably selling longer-term loans. So it's if it's short term, you're probably going to have only short term, and then you're going to run afoul of the 5% rule anyway. So it can be a little bit tricky. As an exercise, because I'm a curious person, I tried to model out to see if it was possible. And you could construct business models that were lending businesses that were compliant QOZB businesses, but it would be a pain in the butt. So I would not recommend it. Other than that, partnership interests are non-qualified financial property. So if you acquire 80% of an LLC, then that's non-qualified financial property. If you acquire 100% of an LLC, though, then it does not count as that because it's a disregarded entity for tax purposes. So that's a nice workaround. That's how you can acquire LLCs without running afoul of the 5% rule. And if you have a C Corp that you want to acquire, you can't acquire it directly because that would be stock. The stock would be non-qualified financial property, but you could convert it to an LLC and then acquire the LLC. So that's a nice workaround. Yeah, so repeating what I said about LLCs, if you have an LLC, if your business, so you set up your QOZB business, you buy 60% of an LLC. So your business acquires 60% of another business that's structured as an LLC. That 60% of that LLC is non-qualified financial property. So that might push you over the 5% rule. However, if you buy 100% of that LLC, then the LLC is treated for tax purposes as a disregarded entity rather than a partnership. And that means it's not non-qualified financial property. It's fine. So it does not count against you for the 5% rule. Does that make sense? Awesome. So then you have the working capital rule. The working capital rule says, well, hey, I mean, if I can only have 5%, sort of financial property, how am I supposed to run my business? Like I need cash. I may have receivables that are like, if I'm financing my buyers, then I may essentially have short-term loans that are out. And the working capital rule says, as long as you have a document, a policy in place that lays out, here's what's reasonable for this type of business. This type of business generally requires this amount of working capital. And you stay compliant with that and update it when things change in your business, then you're safe. That anything covered by that working capital document will not count against you. But this is very important. You have to maintain that document. If your finances ever get out of sync with that document and you get audited, that is something that the IRS is going to look at and say, you didn't stick to this working capital document. So that means that you had this large amount of stuff that you had a bunch of cash in the bank. Maybe you had some short-term treasuries. And that may count as non-qualified financial property now. So you do not want that to happen. The 5% rule is a very important rule. So you need to make sure that you keep that working capital document up to date. It needs to be crafted from the beginning so that it actually makes sense. It actually is justified in terms of here's what this business is, like here's what the business model is, here's how much cash we expect to be able to, we use, do we have a difference? Do we have a maturity difference? So essentially, like, are we collecting on a 30-day rule, but we're paying out vendors on a 90-day rule? That's going to create more cash that's held inside the business. And so then it's reasonable for more cash to be held inside the business. And you can say that in the working capital document. You can say, hey, we collect a lot of cash up front, but we pay out over time. Because of that, we need a lot of capital, and that's fine. That's not going to count against you. You can even invest it into treasuries, and that's not going to count against you. But you have to have it backed up with that document. And if your business model shifts, so maybe originally it's like, well, one product line, we collect cash up front and pay out over time, but a different business line is reversed. We actually finance our customers. So we end up, paying out services over time, and then we collect at the end. So if the ratio of those two business lines shifts within your business, you need to update the working capital document. Otherwise, you risk running afoul of that rule. Finally, you have the QF reporting rule. This means from the investor's perspective, so you get an investor, they invest into your business, they have to do this through the QOF. So if you remember our initial sequence of like 5 things that happen, the investor has a capital gain. Within 6 months, they invest that into a QOF. Within 6 months of that, they invest into the QOZB. That QOF, that Qualified Opportunity Fund, is the direct owner of the QOZB. You have investor, owns QOF, owns percentage of the QOZB. If the QOF, the QOF is everything to the investor. If the QOF is not compliant, then it doesn't matter if the QOZB is compliant. As far as the investor is concerned, they still lost their tax benefit anyway. So for them to be sure that that is compliant, in the rules of the Qualified Opportunity Zone regulations, says that the QOF needs to get sufficient information from the QOZB on a regular basis to demonstrate that it's meeting the rules. So your QOZB needs to give financial reports to your investors on a regular basis that show, these metrics of like, hey, we're meeting the 50% rule, we're meeting the 40% rule, meeting the 70% rule, we're meeting the 50 or the 5% rule. We have a working capital document. All of those things should be in place. And it's not a super hefty requirement. It just means that you need to calculate your, on a regular basis, your compliance with those things. Like, okay, 57% of the total gross income is being derived from OZ business activity. And then you have the records internally to back that up, but you just need to provide them with the financial statement that says, this is true. We're meeting the 40% rule, meeting the 70% rule, meeting the 5% rule. And not every QOF is going to be good about asking for this. Sometimes, investors set up their own QOFs and then they just sort of think, I'm investing in the QOZB, they're compliant, that's fine. But even if they're not asking you for it, you have to send it to them because it's going to cover your butt and it's going to make them grateful in the end when they actually need that. So operationally, that's sort of the specifications, right? The specifications are we needed to meet those different percentage rules. We need to meet the working capital rule. Those are the specifications for what's required. Operationally, how do you actually implement that? How do you actually stay compliant? There's an initial phase of compliance and there's an ongoing phase of compliance. The initial phase of compliance is I need to form my business entity, right? So I need to ideally form a new business entity. When I'm acquiring this business, I'm going to ideally do an asset sale, or I'm going to restructure the organizational documents at least to make it a special purpose entity, to make it an entity that is for the purpose of being a QOZB. I then need to relocate tangible assets. So I think I started to say this earlier, but then got off track. Let's talk about the example of a landscaping company. If you have a landscaping company that is currently located inside an opportunity zone, all of the landscaping equipment, and let's say they have an office there too, so they park the equipment there. During the day, they take the equipment out. They go mow lawns that are inside and outside opportunity zones, but they always come back and park inside the opportunity zone at the end of the day. That would be qualified opportunity zone business property, all the equipment even. But if you buy it, so if you acquire their business, which is already inside the opportunity zone business, or already inside the opportunity zone, it is no longer qualified. So from the QOZB perspective, you have to have new money or new capital that comes into the opportunity zone. You can think of it, right, like at the high level, the goal of the opportunity zone tax incentive, like why it exists, why does this loophole exist? It exists because opportunity zones are census tracts that are poor. And so politicians wanted to move money into those census tracts. Say, hey, invest into these areas. So if you buy an existing business there, that's not investing new money into there. That business was already there. So you need to move new money into there. There is a loophole to this, which is that you can actually move equipment from one opportunity zone to another, and that still counts. So if I buy opportunity zone that's in, opportunity zone A, and then I move it to opportunity zone B after I buy the business, then that actually does count as new property. But ideally, you'll buy a business that's next to an opportunity zone, and there's opportunity zones everywhere, like they're all over the place. So you're not going to have trouble finding one that's close by, especially in states that are the most populated. So in Florida, in California, in Texas, you have a lot of opportunity zones that are literally all over the place. The opportunity zones are small, and they tend to be scattered. In some states like Colorado, it's a little bit harder. Colorado's opportunity zones are kind of chunky. So you might find yourself a little bit farther from an opportunity zone if you're in Colorado. But in most states, you'll be able to find opportunity zones that are not very far from where you are. I'm in West Palm Beach, and there's opportunity zones all around me, basically, even though the area is nice. So because it's at the census tract level, which is really fine-grained, there tend to be opportunity zones everywhere. And also poverty or poor is defined relative to the surrounding areas. So you can have an area that would be well off by national standards, or at least not poor by national standards, but it can still be an opportunity zone. There's also opportunity zones that are next to colleges frequently, and those are not bad areas. They're just artificially depressed because students don't make a lot of money. So even if there's money that's going to those students from their parents, so the opportunity zone might not be that poor of an area, it could still be an opportunity zone. So there's literally there's opportunity zones all over the place for all sorts of reasons. And so the ideal is you find a business that's near an opportunity zone that's relocatable. So if you have, if you're looking at a manufacturing business, like an established manufacturing business, that's probably not a great business to buy. It's probably not going to work out. You probably should not try to make that opportunity zone business, because if you have a lot of equipment that's already in place, you're going to have to move all of that. An even better example would be a foundry, right? If you want to get into metalworking, like a machine shop or a foundry, almost certainly you should forget about the opportunity zone business idea, unless you're going to build that a lot, right? If you buy a foundry and you're like, well, this is kind of a rundown foundry, but I'm going to add 3 furnaces to it. Okay, now that could work. But if you're just going to take it as is and sort of grow at a normal organic rate, the bad business, because even if it's if it's not an opportunity zone, you're not going to be able to move it. If it isn't an opportunity zone, that doesn't count. So not an easy business to relocate, not going to work. If you have, keeping track of the types of businesses that you should not do opportunity zones for, things that are very difficult to relocate because they have a lot of expensive, heavy equipment. Anything that's on the sin business list, and anything that's in finance. Those are categories that you should not do. But if you are looking at service businesses, most type, and by service, I'm excluding things like retail and restaurants. I mean, like, higher end services or consumer services, business B2B services or consumer services, as long as it's not too tied to a particular storefront. Those are pretty easy to move. And so you find one, you move it into an adjacent, a building that's a mile down the road that's in an opportunity zone. And now that counts, that qualifies. So in the initial phase, to make sure that you're compliant, you need to relocate those tangible assets. So you find your business that's outside an opportunity zone, or maybe it's inside an opportunity zone, but you can move it to an adjacent opportunity zone. You relocate those tangible assets, at least enough of them to meet the 70% test. You need to review all your service contracts. And remember that, some things might be borderline between leases and service contracts, but you need to review those to make sure that you're meeting the 70% test if they count as leases. And that could be, real estate leases. It could be computer leases. You're renting raw, bare metal computers, any kind of leases. If you're leasing equipment, that also would count. You need to look at all of those to make sure that you're meeting the 70% test. You need to relocate your payroll. So if you're going to go, you need that 50% test to be met. The payroll is the easiest one to do, the easiest, method of meeting that. So you need to make sure that at least 50% of your payroll is going to employees and contractors that are in an opportunity zone. It doesn't have to be the same opportunity zone. That's important. So you don't have to have everyone in your company in the same opportunity zone. If there is an employee who lives in an opportunity zone, they can work from home. If you want to hire someone on the other side of the country, there are co-working spaces that are in opportunity zones. You can just say, hey, you can't work from home, but you can go to this co-working space and you can work from there. As long as at least 50% of your payroll to employees and contractors is going to people in any opportunity zone, you're good. But you need to make sure that when you buy the business, you relocate enough of them as necessary to meet that test. You need to create your working capital plan. So that document, that super important document to talk about why your working capital is reasonable so that you meet the 5% test. And you need to review your intellectual property, your intangible property. So franchise agreements, licensing agreements, trademarks, copyright, patents, anything that's intangible. If the existing business has, let's say that you don't do an asset sale, you actually acquire an existing business entity, restructure the organizational documents to say that it's for the purpose of being a QSEB, and that business carries some goodwill on its balance sheet. You're going to want to make sure that you keep track of that, because that's going to move with the tangible and personnel, the tangible property and personnel. So you need to make sure you account for where that's going as well. After that, you have the ongoing compliance. So you have this business. How do you keep it up to date? How do you keep it compliant? It basically has tentacles into your entire finance department. So bookkeeping. If you're familiar, if you've done your own books in the past, or if you've ever, looked in detail at what bookkeeping is, right? It's basically tagging all of your transactions. And so as a part of that, you need to tag your transactions, whether or not they're going to things that are in opportunity zones or not opportunity zones. So you have income. Is that coming from an opportunity zone or not an opportunity zone? Payment. Are you paying for something that's in an opportunity zone or not an opportunity zone? Do you buy new equipment? Is that new opportunity zone business equipment, or is it not new opportunity zone business equipment? You can buy used equipment in an opportunity zone as long as it's not the same opportunity zone, right? It has to be new equipment in the opportunity zone that you use it in. So you need to tag those transactions. You need to keep track of the offsite equipment and personnel records. So if you have a business that's sending a lot of people out to do work. Like let's say you have a home service business, right? You're constantly sending out your employees or contractors to do work off-site. Then you should keep a record of the hours and locations. Like, okay, this person is doing, this job out of opportunity zone, this job in opportunity zone, this job out of opportunity zone. Payroll, you need to keep track of who are you paying, contractors and employees, and are they working inside an opportunity zone or outside an opportunity zone? If they do both, if they split work, you need to keep track of that also. Accounts payable. So if you're paying vendors, this is again sort of the same thing. You need to keep track of, is that for services that are inside the opportunity zone or outside the opportunity zone? Or if you're buying something, is that tangible property that's going to count as opportunity zone business property or not opportunity zone business property? Accounts receivable. So you're receiving money now. Is that meeting the 40% test? So are you financing them? And if you're financing them, do you have that reflected in your working capital document? You have the 50% test, which is, I'm receiving something, I'm receiving money. Is that money coming for service that was rendered outside or inside? The 70% test. So I record this twice because it sort of accounts, depending on how your finance system is set up, that may come in at the bookkeeping level or it may come in at the accounts receivable level. If the accounts receivable level is what says, here's who this was actually received from, and here's their mailing address, and that mailing address is outside an opportunity zone, then that's not opportunity zone, service rendered if it was on site to their off-site location. On the other hand, if that information goes down to the bookkeeper, then you keep track of it at the bookkeeping level. But all these together, bookkeeping, payroll, accounts payable, receivable, are basically tracking, where is this money coming from or where is it going to? Opportunity zone, not opportunity zone. So you set up your systems to track all of that. Your bookkeeping software, your chart of accounts needs to have opportunity zone tags. Your payroll needs to have tags for people, opportunity zone work, not opportunity zone work. Payable, receivable, both need, as you're processing invoices, you need to know, is this a service or is this a product that counts towards, opportunity zone services or opportunity zone products, the 50% or the 70% test respectively. You also have to think about treasury management. So where are you putting your cash? Are you putting your cash into, are you sort of running on fumes, in which case you don't really have to worry about this? Ideally not. Hopefully your business is not running on fumes. Maybe it is in the beginning, but hopefully it won't be forever. In which case at some point you're going to have to start worrying about that. And so do you buy treasuries? Do you buy short-term commercial paper, money market accounts? Where do you put your money? And you need to make sure that whatever you do, you don't run afoul of that 5% non-qualified financial property rule. So I can't just go and say, hey, I have a bunch of cash sitting around. I don't see a way to invest it, somewhere else in my business. I'm going to start lending it out. I'm going to start providing more financing to my customers and, give them 3 years to pay back, because now those 3-year loans are all going to count as non-qualified financial property. Or, you say, oh, I'm just going to roll this into 2-year treasuries. Again, does not count. 2-year treasuries are not qualified financial property. So you need to make sure that you're not putting them into that. Managerial accounting, sort of tying all of this together. So whether, you're using some sort of ERP system, you have a proprietary system, you just tie it all through QuickBooks, whatever you do, you need to make sure that you're regularly checking that all of these things are compliant. So, I would set up reports to be run regularly. Ideally, you have software that can then track all of this, but you also need to make sure that whatever people you have doing are aware of how this works, so that they're tracking like payroll, right? The payroll one is super important. If you have people who are working inside and outside opportunity zones, you can't just say, well, they're working inside an opportunity zone some of the time, so I'm going to count them that way. Because as soon as you're audited, there's going to be some other record in your company that shows that they were outside working at some point. And then the IRS is going to say, wait a minute, you don't have documented when this person was inside and when they were outside. So we're going to write off their whole payroll. Their entire payroll is going towards the, outside opportunity zone bucket. You do not want that to happen. So you need to make sure that you're, at the managerial accounting level, You track that. You track all of these different rules, the 50% test, the 70% test, the 40% test, the 5% test, and the working capital. All of those have to be tracked. The investor financial reporting. So remember, you have to provide the QOF. The investor has a QOF. That's the vehicle which holds the equity in the QOZB. In the QOZB is your business. So that QOF needs records. So you need to send them regular records that show that you're compliant with each of these different rules. In the HR process, you need to make sure that you are, capturing the right information. So if you're hiring someone, make sure that you note, is the person working from home? If so, do they live in an opportunity zone? Yes or no? Are they working from the office? If, 100% of the time? Are they ever going off site? If no, then they're fully in the opportunity zone bucket. If yes, then maybe they're split and you need to record that. And, maybe you let that influence your hiring decision, maybe not. But you need to have that process in place that every time you hire someone or you bring on a new contractor, which bucket are they going into, or what percentage are they going to each bucket, OZ versus non-OZ. And then you have some sort of ongoing but irregular thing, which is M&A due diligence. So again, transactions can be tricky because you can't acquire stock. You can't acquire partnership interests. You can acquire assets. You can wholly acquire LLCs. So you need to make sure that if you're thinking about an M&A deal and you want to, and it's possible that at some point you're like, this deal is just, it's so great, I'm going to do it, even though it's going to break the opportunity zone business framework. If so, so be it. Maybe it's worthwhile. But usually you can find a way to structure it the right way. Again, that's a problem that it's more occurs at the VC level. Like if you're looking at a super fast growing startup, they're like quadrupling their headcount in a year. That's just hard. It's hard to stay compliant with those rules because you have to make sure that they're in the right places and you're acquiring the businesses in the right way, and you have to restructure the business from a C corp to an LLC and then acquire that, or you have to buy the assets. It's just tricky. Also, more of the M&A activity in the VC space is C corps, which complicates things, versus a lot of, more of the M&A activity in the search funder space is LLCs and asset deals. So that's already structured better for opportunity zones. It's easy, but you just need to make sure that you stay, if you need to make some sort of adjustment, like, hey, do we want any sort of vesting? Like if you're buying let's say that your company grows, it's $20 million business and you're acquiring a $3 million business that's set up as an LLC. You don't want any sort of vesting per se for the owner, because then you're acquiring not the entirety of that partnership interest. So you have to be careful of that. You might vest them interest in your LLC or your C corp, but you don't want to do anything, too fancy with their LLC. You just want to acquire the whole thing. You also need to make sure that if, let's say that you're acquiring a business that's outside a opportunity zone, do they have a bunch of 2-year treasuries that they're holding in their treasury, their corporate treasury? Because that might push your business over the 5% limit as soon as you buy them. So you may have to structure the deal such that, okay, we're buying your company. You need to write out the timeline of like, here's what's going to happen. We're going to sell these treasuries into this as part of the first part of the transaction. So we're going to get rid of the 2-year treasuries and put it into a 1-year treasury. We're going to then acquire the LLC. We're going to then update the working capital document to explain why we have more working capital and how we're going to spend it, or whether or not it's reasonable to keep it. So that non-qualified financial property can be something that you have to pay attention to during any type of M&A. The 50% rule, again, is there tangible property outside the opportunity zone? If so, you're going to be the 70% rule, is there tangible property outside the opportunity zone? If so, you're going to need to bring in a portion of that inside the opportunity zone. And the 50% rule, where's the business income coming from, right? Like, are they serving all of their customers outside an opportunity zone? If so, that's okay. You don't have to get rid of their customers. You just have to make sure that you meet the 50% rule a different way, like the payroll method. So you can serve people who are outside opportunity zone. That's fine. All your customers can be outside opportunity zones, as long as you meet the rules in a certain way, right? The 50% rule, saying that 50% of your income has to come from opportunity zone activity. There were 4 different ways to meet that, right? Payroll, hours, facts and circumstances, and managerial effort. So as long as you're meeting at least one of those, you're good. But you need to think about that when you're acquiring a company. There are some wiggle room. There is some wiggle room in the different rules. So for example, let's say that you acquire a business and it is going to be over 5%. You're going to have more non-qualified financial property than the 5% rule allows for. That can be okay as long as you get rid of it fast enough. So there's leeway in the 5% rule. And there's also some nuances, like the 5% rule, it actually applies to the unadjusted basis of property. So let's say, for example, that your company bought, a few shares of stock in some company, and that company went to the moon and was super valuable. It actually became more valuable than your entire company. If you hadn't sold any of that stock, you hadn't been day trading it or anything, you just held it, then its unadjusted basis is still fine. So you're actually still under the 5% rule. So that's a nuance of the 5% rule. It applies to the unadjusted basis of that non-qualified financial property. There's also an average thing. So it's like, as long as you meet it the majority of the time. So there can be spikes when from time to time, particular transactions may cause you to go over the 5% rule. But as long as those spikes are very short and you handle them, you won't violate that rule. Same goes for the 70% rule and the 50% rule. So you have a little bit of flexibility in that regard. Really quick, I want to recap just how I would approach an investor with this. So you have, if you're trying to raise money for an acquisition, the ideal type of investor to go to is a high net worth individual or a family office. Most PE firms and most VC firms, not the right kind of investor, because they are not interested in taxes, right? Like, they don't think about taxes. But a family office is very holistic, right? Like, they deal with everything about this person or this family's finances. So taxes are very important to them. And they have a lot of money. They have a lot of capital gains. They have different types of investments. So they constantly have a stream of capital gains that are coming in from different sources, be it real estate, stock sales, hedge fund gains, a sale of an operating business, whatever it is. They have a lot of sources of capital gains, and they care a lot about holistic planning with taxes. So I would go to them. A lot of them, most of them, I would say, are aware of opportunity zones now. They may not be aware that you can invest into businesses. So I would approach them, say, hey, I'm raising money to acquire this business. Ideally, you form some sort of relationship with them before you find the business. So you reach out and say, hey, I'm actively looking for a business. Here's my criteria. You don't have to raise any money for them. You just say, would you potentially be interested? And from time to time, you can send them updates on how your search is going. That's ideal, because then you're not coming out of the blue and they have a little bit of trust in you. So you reach out to these family offices. Each one is different. So not every family office is going to be looking for this, but plenty of them are. And you say, hey, I'm looking to acquire an opportunity zone business. So, and they'll be like, well, what, real estate? No, not real estate. I'm actually going to apply, the opportunity zone framework to buying an operating business. You explain how that works. You pitch them on the math of it as well, showing them basically, you compound at this, X% per year on average, let's say. You can show them different scenarios. You get this much capital gain at the end. So you have this deferral period initially. Sure, deferral is great, but really you have this effectively a super Roth IRA. That's basically what the end result is. You have this super Roth IRA that you can hold for 24 years at maximum. And that's very attractive. If you can have an investment compound tax-free for 24 years, and sell it with no capital gains tax, you're saving them. The capital gains tax rate right now is 20%. The net investment income tax is another 3.8%. So you're saving them like 3.8% or 23.8% on their investment in the end, on whatever gain they made, right? That's almost a quarter. So you're saying literally like, hey, I'm going to make this a quarter better. Like you're going to lose a quarter of your investment to taxes. Now you get it back. That's pretty attractive. So if your deal should already be attractive, right? Don't settle for a subpar deal just so that you can get the opportunity zone tax framework. But if you find a deal that it works for, which is most service businesses, like most search fund scale service businesses can be easily converted into opportunity zone businesses. So if you find a good deal that's a service business, then you just say, hey, here's this business. We think it's a great business deal on its own. But by the way, also it's an opportunity zone business. So you get to save a quarter of the gain that you make on taxes. Show them the math, show them how that works. And it's a very attractive proposition. Like I said, I think there's a literal scarcity of these businesses. Almost nobody builds them. Part of the reason for that is opportunity zones are transient, right? Like they were created by Trump and they expire in 2027. So from now until 2027, and by expire, I mean, that's when you can get into them. You can hold them till 2047, but you have to be into them by the end of 2027. Or basically you have to have a capital gain by the end of 2026, then you pay taxes on 2027. You have to be into it by then. So you have like a few years. So because of that, I know, there's just not as many people who have like studied the market. So there's not a lot of people who build businesses in this area. But if you make that investment, right, if you structure your business so that it is set up that way, it's very attractive so that it makes it easier to raise capital and it makes it easier to get more equity, right? If you were going to say like, oh, I'm going to end up retaining 20% of the equity in this deal. Well, if they were going to have 80% of the equity, but they were going to lose a quarter of that effectively when they sold it, then, maybe you're like, oh, well, this is worth at least 25% equity to me now, right? So the value to you in terms of fundraising is like, one, makes fundraising easier, but two, you get to keep more equity because you're bringing more value. So that's pretty nice. So like, and I would say the common objections you would hear, right, are like, one, do you have to sacrifice growth? And the answer is no, not if you're in the right type of business, right? If you're a VC fueled startup, then yeah, I would say it's hard to do that because you are probably going to have to sacrifice growth. You're going to have to limit the types of M&A activity you do. You're going to have to limit where you can hire people. But for a search fund style and size business, it's pretty effective. It's pretty easy to do that. You don't really have to sacrifice anything. You just need to make sure that you stick to the rules. As far as the cost of compliance, it's also not that high. Like, so the way that like when I consult with investors is I offer a couple of services, right? One is I will basically help them set up the opportunity zone business. And then two is I will charge them, if I'm participating in the business. So if they want to run the business themselves, they go for it. I just help them structure it. If they want help with the ongoing compliance, then I charge 2% of the revenue basically for the period of time. And then I do all of the finance function. So if you look at like how much the average company spends on finance already, you're spending 2%. So, until you get to like $100 million plus, then the percentage, you start dropping off. And when you get to like $1 billion in revenue, then the average, your finance, you're spending like 1.2%. But for like 50 million and under, you're spending about 2% of your budget on finance. So it doesn't cost anything else for compliance because I'm just wrapping the finance into the same role. So if I can do that, other people can do that. You can do that. So the compliance is not, as long as you know what all the compliance steps are, it doesn't really add a unnecessary cost. So it's not like you're spending 2% on finance for arbitrary finance, or you're spending 2% of finance just for So normal finance or finance plus compliance, same thing. It doesn't, you just have to set up the systems properly and track the stuff the right way, but it doesn't really add any cost. So if you don't have to sacrifice growth because you're not doing VC style M&A, and it doesn't add anything in terms of extra cost really for compliance, then the only cost to them is basically the upfront fee that, like if I'm helping them set up, that I charge, which is much less than they get in the end. So I think it's pretty attractive to an investor. And if you lay it out that way, or you go through like, those are the objections, like you pitch them on, here's the benefit, you get to save a quarter of the taxes. The cost of compliance is essentially nothing. And then maybe you pay an upfront fee or not. If you do it all yourself, you don't have to charge them anything for upfront. It's just like, hey, I guess your upfront fee would be equity, right? You say, I'm going to take a little bit extra equity. So that would be how I would approach investors. And if you are looking for, if you decide to do the opportunity zone framework, if you find a business and you want to invest that way, I would certainly be interested. So, pitch me. I have no, not guaranteeing anybody anything, but like certainly be interested in at least looking at anybody who decides to run with this idea. Yeah, so let's do questions. Let's see. One chat question. So you might have stated this, but how do you identify OZ across states? I'm in Washington. Can an HVAC business qualify for OZ business benefits? Yeah, so there are opportunity zones in every state. You don't have to be in any particular state. You can have, as long as you meet those different rules, like as long as 70% of your tangible property is in an opportunity zone, and it doesn't have to be one opportunity zone. It can be spread across different opportunity zones. So you could have, you could have an office in Washington and an office in Oregon and an office in Idaho, and each of those in an opportunity zone. And you can even have an office that's not an opportunity zone as long as it doesn't run afoul of the 70% test or the 50% test. So if 1 in 4 offices is not an opportunity zone and the payroll is equally distributed amongst those, you're fine. That still works. Yeah, see you later. See you later, Alex. So yeah, HVAC business definitely can qualify for opportunity zone. Other questions? Feel free to unmute yourself too if you want. So you ask in the chat or ask via audio.
Yeah, I'll jump in here. Thanks for I appreciate when other people are passionate about stuff and can work on it for long periods of time and not really get tired, because I have ADHD brain and so I do it often.
Yeah.
So thanks for sharing one. So I kind of have 2 questions. Decently familiar with the advantages of OZ. I had an initial search thesis kind of at the intersection of we'll call it like emerging franchise brands, right? And having like long-term stakeholders where, you end up on the front page of your reports with your city. You're bringing like an emerging franchise brand that new into that area. So you have like kind of a 10-year multi-unit development plan, which then leads into like the 10-year plan. It's like a long-term strategy play, right? Where on the front end, at least incentivizes everyone. But what I was a little confused about is, so the initial deferral right through 2026 or 2027, what is the difference between those initial funds and then the eventual, say you hold for 10 years, total capital gains, like tax-free event? Like what happens to those initial funds after 26 or 27? Is there actually a tax, or because my understanding is the shorter of whenever they hold, like I guess what happens to those initial funds at that point?
Yeah, so let's say that you invest $1 million today. You have $1 million capital gain you invest today. That means you defer $200,000 of capital gain taxes until you file taxes in 2026, which is usually early 2027, can be late 2027 if you have an extension. At that point, you're going to have to pay the $200,000 in capital gains tax. So you invested $1 million, right? You had $1 million of gain. You have to pay 200,000 now. This will depend a little bit depending on investor. So if you have an investor who doesn't need liquidity, right? Let's say you're talking to a family office, they have other investments for liquidity. This is meant as a long-term investment. They have 200,000 from another source. They have 200 grand in the bank account,
Right.
or they can call it from a hedge fund. They can pay the tax with that, in which case you just hold on to it. You keep going. That, I think, is the ideal scenario, especially because at least with the type of clients that I deal with, I would say there are a lot of smaller investors in opportunity zones who are, they're millionaires, but they're not multi-millionaires. They're not billionaires, right? They have a lot, the low level investors do have a higher need for liquidity often. So sometimes funds that tailor themselves to those types of people will say, hey, we're going to, again, they're typically real estate. So they'll say, hey, we're going to refinance our property and give you a distribution at that point to cover the tax bill. So in principle, you could give them a dividend, or you could, if you could up the financing of the business to give them a distribution if they needed it, and if your investors needed it. But I would just set that up at the beginning of the fund. So when you first are structuring the business and you're raising money, know that, if you're targeting sort of ultra high net worth individual, people with like tens of millions of dollars at least,
Right.
they probably don't need the liquidity. So they're going to pay the tax bill out of something else, in which case you don't have to worry about it. If you're sort of targeting, a more mainstream investor, they have a couple $1 million of net worth, they're investing a smaller check, they probably are going to need some sort of liquidity, or at least there's a decent chance that they would. And you definitely want to be upfront in the beginning about that, like, agree upon that before you do anything. Like, hey, is this going to be a business that we give you some sort of distribution in 2027 to pay that tax bill? Or are you going to pay it out of a different source? If they pay it out of a different source, it's also better for them. As long as they can afford to do that, it's better, because you get to compound all the money inside the opportunity zone for as long as you hold it. See you later, Alex. Great to have you too.
Right. Yeah. And so but then so for the long term, 10 years though, their basis is based upon over the $1 million contribution at that point. Anything over what they contributed to the QOF and to the QOZB is tax-free.
Yes. Anything. So all of the gain on, there's, sometimes the phrase is like, there's the gain and there's the gain on gain,
Right.
Because it's like you have a first event, which gives you a capital gain. You invest that capital gain and you get a capital gain on the amount of that initial capital gain.
Right.
So the first capital gain, the gain is tax deferred.
Right.
The second gain, which is the gain on the gain, is eliminated. You never pay it. So,
Right.
You invest that $1 million, you sell it 10 years later for $4 million, you have a $3 million gain. You don't pay any taxes on that.
Yeah. Okay. I was just making sure, because gain on gain is sounds like, we'll call it a muscle memory. Yeah. And then this other piece was, because like you mentioned, a lot of open source resources. I think with Daniel Pissar, he was a Harvard law guy, wrote a couple white papers about, I think if you don't know him, I can make an introduction. I don't personally know him, but I have his LinkedIn at least. He's another opportunity zone guy. But unfortunately, a lot of open source materials are around, the rules of real estate, right? And I think one of the most important things is these subcategories, like under the 50% and under the 70%, and what actually matters in order to, we'll call it, wield the results you're trying to look for, namely, like what is that? The like managerial efforts, right? Like quote unquote. Do you have something that you have for like being able to diligence or check on these sorts of things? Because I think one of the most important things is being able to recognize when something like that is actually going to be accomplished, and there's not a lot of white papers or open source materials, maybe with the exception of following expensive lawyers like out there.
So you're saying like basically like a list for compliance.
Yeah, I mean, because for instance, right, like 50% for gross income and 70%, and there was what was it, the list that basically talked about how many of the other things, like payroll is 50% tax, like AP is 50 and 70% tax, et cetera, et cetera. But within payroll, right, like the 50% test has multiple sub buckets. And that can be, there needs to be like an implementation plan if there ends up, post closing like 100 days, 180 days in order to actually start getting momentum for it to start fitting the compliance. Otherwise, like it's a moot point, right?
Yeah, so I don't know of anything that is published that is like a complete repository. I've sort of like created my own systems to do this. Part of the issue is that, I thought about at one point like creating a software that would automate all of it. I ended up not doing that. Part of the reason was I didn't think it was worth my time because there's a lot of nuance. Part of the nuance, right, is like the line between the lease and like, what is a lease and what is a service?
Right.
There is literally, like a 300-page IRS ruling document that gives you a bunch of guidelines on when is it one, when is it the other. Another example is like, let's like say you look at a contractor, and that contractor does part of the work in-house, part of it out. And they also hire a subcontractor, right? Like, to what level of depth do you have to look? The closer you are to that line, the more you have to look. So ideally, you don't have to look that deep because you have enough of your own people or sort of easily identifiable contractors that are doing easily identifiable services inside an opportunity zone that you just mark those. But there are edge cases where you may have to look deeper into the inside, the internal structure of what this contractor is doing. That has never really happened to me in practice, but when I was trying to map out all these rules, it's clear that that can happen. So, another one is the intangible property rule, right? The intangible property rule intersects multiple of these other rules, right? Like if you acquire goodwill, like you buy a business, it comes with goodwill, that can be a pretty big intangible property, and that intangible property will move with the tangible and personnel if you move them. But that's not the case for non-acquired intangibles, right? If you have a patent or a franchise, a trademark, a copyright, anything like that, where you acquire it or you purchase it, and then you hold it and use it in some manner, it's going to depend on the manner of use. So there's a lot of nuance, which is, I think, probably why someone hasn't. The closest you're going to get to like a laundry list is just like the 500-page IRS guidelines on opportunity zones, unfortunately.
Right. Yeah, I guess I more mean on like the subcategories to focus on under the buckets, because I think that's one of the most important things to realize.
Like what is the so the buckets, meaning like the 50% rule? Like what are those for?
Yeah, pretty much.
Yeah, so if you look on so if you go to my website axiomalpha.com and like scroll down, you'll see one like an article is called the unlimited tax loophole. And that was the article that I originally wrote, which is from the perspective of as if you're starting a company, not acquiring it, but it does list the 50% rule along with those 4 different buckets that are underneath it.
Okay, I'll look.
And it also lists the like what each of so it lists each of those percentage rules, and then it lists the buckets that are underneath the 50% rule.
Oh, okay, yeah. How to create a QOZB.
Yeah.
Yeah. Okay.
So that's the basic level. Yeah. If you want that level, that's there.
Yeah. Okay. Yeah. I'll at least look at here because I think within all this stuff, you know, people have their different diligence lists. And I think one of the important maybe differentiators is being able to recognize very early on what levers you're going to be able to actually pull if you're interested in
Yeah.
doing something like this, and recognizing when it's just not going to be worth the squeeze, but the investment still might be.
Yep.
Yeah,
I would say, you know, another interesting thing about opportunity zones, which I didn't even have time to talk about, was that, like, you know, I like the way you framed your strategy. Like, opportunity zones overlap a lot of other things. Like, there are states that have opportunity zone rules. So sometimes if you invest in an opportunity zone, you get not only the federal tax benefits, but you can also get state tax benefits. Also, because of the way the opportunity zones are chosen, they frequently overlap other types of zones. Sometimes they're called community redevelopment areas. Sometimes they're called community investment zones. Sometimes they're called economic development zones. Sometimes they're called historic districts, right? But those areas can come with state level income tax credits or exemptions. They can come with state or local property tax exemptions or abatements. They can come with grants, just free money. They can come with job tax credits, job creation and or job maintenance tax credits. There's also the hub zone framework, which is not about taxes, but it's about government contracts. There's a lot of overlap between opportunity zones and hub zones basically give you a huge advantage if you try to apply for to get government contracts. So that's pretty attractive. So yeah, I mean, opportunity zones are fantastic.
Yeah, basically this was something where if it is, I am deeply interested in just getting more tax savvy, generally speaking. Just, what if you're alive, it's the only thing that continues to follow you every year, no matter what else you've signed in your life. You can change your name, but you can't, and you can wield your tax, but tax is always going to be a thing. So yeah. Thanks again for sharing. Appreciate it.
Yeah. You know, they say everything in, you know, life is you know, death and tax is inevitable, but not if you know about opportunity zones. Any other questions?
Hey Patrick, sorry I kept jumping in and out, but I wanted to say I just wanted to hop back in and tell you thank you for putting this together. Quick question. I mean, you know, I would love to believe that people are doing everything out of the goodness and kindness of their heart, but at the same time, are you an advisor, a consultant? Is there like a thing that you're offering? Because I've had to jump out, so I don't know.
Yeah, so I'm my background, like I said, is I typically consult with investors, but there is not, you know, let's say that my biggest annoyance is that there's not enough opportunity zone businesses to invest in. So if you know, ideally I can connect, you know, if I, you know, there's a good opportunity, like you end up finding a good opportunity zone business that you want to create. On the one hand, maybe I can help connect you to an investor, help manage their QOF on that side. Or, you know, if you want help in the setting up of the opportunity zone or the, you know, ongoing compliance aspect, like I said, so for investors, if I take over the management aspect of it, then it's basically like, I'll handle all of your payroll, accounts receivable, accounts payable, managerial accounting. I basically, like, you know, you can outsource all of your finance and then I'll handle all of that aspect to make sure it's compliant. And then I charge like 2% of the revenue, which is basically what businesses in this range pay anyway for revenue. So for me, yeah, it's like, maybe you hire me for that, but really it's the investor side is what I'm really after. So I want more opportunity zone businesses to exist.
No, it makes a lot of sense. It's funny enough, the strategy that me and a couple of friends are kind of been kicking around centers around, we're three minorities, and so we would become minority-led businesses. So with that certification, we go after certain different kinds of contracts. Also, thinking about, just value creation on the back end and being able to scale them. The biggest problem with these suppliers is that they literally can't service the contracts that they're almost eligible for. It's actually the weird conundrum. It's like, oh, you have all these available contracts, and it's like, you don't have the operation scale to do so. So we've been thinking about opportunity zones. It's like, if you are able to think about the tech stack of a lot of these businesses, as well as also getting, if they qualify for these opportunity zones, it makes a very natural kind of like making our firm like a transition point for these to become the suppliers of the future. That's what we're kind of framing it as right now.
Yeah,
So that's the reason
that.
why so I came across your search finder thing and I was like, oh, this is right. Kind of like opportunity zones could be over a long term, a really interesting strategy, especially for investors in attracting capital,
Yep.
sometimes fairly quickly, because to your point, there aren't a lot of businesses that automatically qualify.
Yeah. And you have
funny.
you have a natural time crunch anyway, which is, they need to defer, like they have to make investments on a certain time scale after they have that capital gain. So
yeah, exactly. And having enough available entrepreneurs, available investment opportunities that do qualify, I think could be really, really interesting.
Yeah.
I was curious, thinking about what you're kind of offering right now. Have you thought about like making like a software tool that kind of overlays it to QuickBooks or something like that? Like that kind of like does 80% or 90% of the work, and then you add it, and you can then not would say sell it to accountants, but then you partner with accountants, and then those accountants do that work, and you own the tool, and then you kind of use your expert guidance in this really interesting area.
So I have come to the conclusion that one, there's a lot of variation. So, different businesses, not every business uses QuickBooks, right? Some use QuickBooks, some are going to use NetSuite, some are going to use a different ERP, they're going to use SAP. So focus, just using QuickBooks when I would say, as the businesses get larger too, they're often going to switch to an ERP.
Go out of it. Yeah, you're
and so you have to deal with now, like they may be in multiple different systems. And on top of that, those systems by themselves it's not like you could just build a plugin. Like with an ERP, you might be able to, but with QuickBooks, it's not powerful enough. It doesn't actually have the scope to see all the data that you need. So if you, are inputting data into QuickBooks, but it doesn't have, like, let's say that you have your business actually gets paper invoices and you have to scan those and upload them. There's not necessarily, like QuickBooks doesn't always recognize the address. So you can't necessarily tell if that's an opportunity zone thing or not. And you may have to build a separate piece on top of that. Something like the screening process. So if you're hiring someone, it's easy to forget about that, right? There's a lot of different things you have to track. Treasury management, right? QuickBooks you're not necessarily tracking with enough granularity to know whether or not you're satisfying the 5% rule. Where's your tangible property? By default, QuickBooks, you don't have to even set that up in QuickBooks, unless you're keeping that updated. It's usually going to require something outside. So you could, in principle, you can always build software for something, but in my experience, basically, I right now, I have two ways that I help people. It's either I help them with the setup process, which is basically
initial compliance.
I'm going to help you structure the business, and then I'll set up all the systems for you. So whatever the business is, you want to use QuickBooks, you want to use a different ERP, it's fine. I'll help you set that up. I'll make sure it's has all the right, chart of accounts, everything is set up in there. I'll set up the systems. So I'll create all of your written documented systems that when you hire someone or you outsource, you can be like, bookkeeper, follow these procedures. Payroll people, follow these procedures. Accounts receivable clerk, follow these procedures. Accounts payable person, follow these procedures. And then they can run with that.